now we're at the same point. GDP in the U.S. is comprising a smaller and smaller amount of world GDP, and we have, China rising in the east. In a lot of ways, you see that the Chinese economy has much more freedom than we have in this country.
Over year, retail sales in November to November in China were up 22%.
Mm-hmm. Yeah. I mean, the Chinese, among their top 5 hobbies, shopping is up there. I think it's number 4, along with probably ping pong and gymnastics. So, they're set to do well. Their GDP keeps on growing. So, we see a transition. In this country, what we're doing is propping up markets.
A lot of the concerns that I address every single day with my clients, and I know Steve does as well, it really breaks down to timing the market. Most people that I speak with don't doubt the macroeconomic viewpoints of Peter Schiff. They understand that he is basing his forecast on fundamentals, not on some undue patriotism, not on just some bias towards bullishness. Not because he just, is in the pocket of Wall Street. I mean, he's looking at the fundamentals. And so when you understand these macro trends take time and they take years to develop, the question becomes, well, when is the right time to move into these positions? When is the right time to invest in foreign stocks? When is the right time to buy gold? So many people go broke over time or don't participate in any market movement at all, just sitting on the sidelines, trying to pick the bottom. And do we know with any certainty exactly, when the bottom is or was or could be? No, of course not. We don't have our crystal balls. Only time will tell. Only hindsight is 20/20. But the thing to remember, and I reiterate this every day, is look at the fundamentals of the companies that we invest in. Look at the fundamentals of the countries we invest in relative to the United States, and you'll understand that, look, even if we are just moving sideways in 2009, even if we we still will hold to our philosophy of buying good dividend-paying companies that are going to pay us to hold their positions. I want to recoup those 10% dividend yields. 10% on a sideways movement, you don't have to have capital gains. You don't have to sell stock to see profit. And certainly the portfolios that we're putting together right now with the sell-off that we've seen, I mean, most, world markets, I mean, the U.S. is down, the Dow is down 35% in 2008. I know that definitely hurts a lot of us that were invested. Mm-hmm. The global markets didn't fare much better. The dollar did rally. All these things are setting the stage now for, as Peter said last week, where the dollar, we really do feel it's turning over, and the fundamentals are so compelling that at the very least, even the most cautious investor can take a look at these values, the fundamental values of the investments, and start to dip a toe in the water.
Yeah, and for 2009, what are the fundamentals? Money supply is still growing at 16%. The federal funds rate is, less than 0.5%. We see continued bailouts. Peter talked about $6 billion for GMAC, but $13 billion for the auto industry, and that's just the tip of the barrel. There's more to come. And this increased money supply creation is going to lead to the dollar's weakness. We just don't know exactly when.
No, absolutely. And remember, a severe economic contraction, if indeed that is what plays out in 2009, again, does not mean that we won't see significant inflation because of the monetary creation. The velocity of money that we spoke on, even just a few months ago when we did the radio show, I thought Steve did an excellent job of kind of laying out why we weren't seeing the inflation, even though everyone could clearly see that the Federal Reserve and the Treasury were pumping money into the system. Look, these, ultimately, if we see a return to some sense of normalcy and banks start to lend, you're going to see the inflation. Well, gee, maybe they start to lend to good qualified borrowers, or maybe they just get $6 trillion in government money and turn around and loan to people with 620 credit scores instead of 780 or 720. Pardon me. So we see already a dropping of standards, lending standards. We're seeing it with GMAC. You're going to see the money, the monetary expansion, the quantitative easing throughout 2009. Certainly, that would be our best guesstimate. That is very bullish on the metals. And, if you look back over the last couple of years, the supply, demand for gold outstripping the supply by some 50%. I mean, we just cannot, we just do not envision gold not keeping track, certainly. And so that, we're hitting that point right now, gold, because it's just, when we look at some of the values and we look back over what we talk about every single day, it's just such a compelling investment, particularly the mining positions globally. And now, a lot of gold miners, precious metal miners, they're not paying the dividends. They're not, certainly, only one asset class that we invest in, but it is a big part of what we do because, again, preservation of your purchasing power. And if you look at gold priced in other currencies throughout 2008, gold had a banner year. I mean, it did very well. And, when all this expansion, a lot of people think, gold performed so poorly in this financial crisis throughout the fall. Not really. The dollar rallied as we saw deleveraging, as we saw a rush back into the, treasuries. Of course, gold did, sink priced in dollars. But if you looked at gold priced in euros and the Australian dollar, the New Zealand dollar and Canadian dollar, I mean, it was at all-time highs.
Yeah, and what we're thinking about is preserving purchasing power. If you had gold, you can buy more oil, nickel, wheat, corn, soybeans. You can buy more of the things that you need to buy, and that's what matters. And going forward, it's going to continue to do that. It's for 2,000 years it's been seen as a currency, and it still will. We see some of the industrial metals made a comeback for this year. We see, we spoke about the industrial commodities. But beyond that, we see that a lot of the risk has been taken out of the market. This last year, $30 trillion was lost in the global markets completely. But the biggest thing that was lost was confidence. And I think, for us, that's a good thing. Because when we see where stock prices are today, we see that it's the other side of the coin from February of 2000. People really very easily understand that in February of 2000, stock prices didn't deserve to be where they were. We knew fundamental values were lower, and we were fine waiting it out, and when they fell, we accepted that. Now stock prices are artificially low for some companies in some countries. And, we don't necessarily think that the market, as volatile as it's been for the last year, can correctly price certain equities. Going into 2009, if you guys are traders and you follow the VIX index, volatility went from 85 to 40. So half of the volatility has been taken out of the market, which kind of means that people are starting to come to a consensus. People are starting to understand that, stock, maybe oil shouldn't have gone as high as it did in the short term. Maybe it shouldn't have gone as low as it did. We hit as low as 34 a barrel, and now we're back over 40 as the February contracts rolled over. So, going forward, less volatility, more dollar weakness, fundamentally speaking, and, from here going forward, equity prices being much more stable.
Yeah, and speaking of going forward, everybody's got a prediction on 2009. I know Steve and I could probably just sit up here on our soapboxes and talk for the rest of the hour, but if you've got a prediction on 2009, please feel free to call and let us know what it is. Our phone number here to call in is 888-678-9597, and we're going to start taking some questions. So we'll start with Nick in Ohio. Nick, you're on the air. Are you there?
Yeah, I'm here.
How you doing today?
Hey, Nick.
I'm okay.
Happy New Year.
Okay, my question is this. I'm actually a college senior. I'll be graduating in May, and the job market isn't looking too great.
Mm-hmm.
I've applied to a couple of graduate schools, and I was wondering if you have any opinions on whether I should whether graduate school is a good thing to invest in at this time for myself, or whether I should just pursue trying to find a good job, if you have any opinions on that.
No, absolutely, and thanks for calling in, Nick, and congratulations on your upcoming graduation. I would absolutely, borrow the government money while it's cheap. I mean, if you can go to graduate school and you can borrow and get student loans that when you consolidate them, they're fixed at 3 or 4%, which we anticipate, in my opinion, interest rates are going to be low. I'd absolutely. I mean, take the free money while it's there. Get a better education. Put yourself in a position to have more knowledge, and potentially, I mean, the job market may or may not be better when in a couple years when you graduate. Who knows? But absolutely, I'd take the money while it's on the table. I'd always, be biased towards getting an education, especially in light of what we see or what you've seen in the job market. Right? What's your major?
Computer science and engineering.
All right. Okay. So I mean, you're seeing right now. I mean, there's a bubble in computer science and computer science engineers. I mean, everybody. I remember, going back. I mean, it was when I was in high school, it's you have to do something in computers. You have to. There's a shortage. Engineers are going to make tons of money. Everybody goes into those fields, and then now, of course, what happens? We see now that there has to be a recession, quote unquote, in demand for that, and so it hurts, And so if the net is at the end of the day, you can graduate with your undergrad and then go into your master's or your graduate degree and get that free money at 3%. Where hopefully if you're wise enough, and it sounds like you're listening to this program on New Year's Eve, so you've got a, at least there you got a good head on your shoulders. So, you know, look at the result. You know, you can invest the funds that the earnings that you'll have, put them overseas, put them in gold, put them in